Hello everyone, my name is Edward and today I'll be presenting on monetary policy and investor expectation, looking at how US monetary policy expectations shape global capital markets. This presentation is part of International Finance and Global Capital Markets course taught at Trinity Western University by Professor Lepine. The outline of my presentation is my presentation will follow this outline. At the end of my presentation, I came to the conclusion that the speech made by Powell on 22nd August did shape investor expectation, and by so doing caused the global capital market to shift or react. And it's so clear by the data we see from the world index equity and bond index markets. Expectation in general is in finance is said to be self-fulfilling because what investors expect to happen will influence their behavior, and that behavior eventually becomes the reality. And so expectation is very, very important concept in finance. One will ask, what are some of the factors that shape investor expectation? One is corporate announcement, and this is the annual announcement of earnings, the announcement of merger and acquisition, and so on and so forth. This is research has established that such announcement really shape investor expectation and cause the global capital market to move, and we can see work by Hugh 2024 and NINFA 2025 establishing that. But the focus of this presentation will be on the direction of monetary policy, how the expectation of how Fed's monetary policy do shape the global capital market. And it's so clear, US GDP, according to World Bank in 2024, is held at around close to 30 trillion, and close to 60% disclosed global official foreign reserve as of 2024 was held in US currency. So it is the primary reserve currency issuer around the world. Monetary policy, as we have come to know, can be expansionary or contractionary depending on how the central bank Fed adjusts interest rates or enter the open market or adjust the required reserve ratio. The impact of this expectation on the equity market is well researched, and a work by Roma and Roma 2000 has really established the fact that expansionary monetary policy will reduce the risk premium and drive stock prices higher. Similarly, the converse reaction is expected when Fed pursues tightening or contractionary monetary policy. We expect to also see some impact on the bond market, and this area is also well researched by Nishkin 2007, who established the fact that when investors expect the central bank to tighten, for instance, monetary policy by raising interest rates, bond prices typically declined as existing bond fixed interest payment become less attractive compared to the new issues and the new bond which is issued at higher prices. And there is a converse or inverse relationship between bond price and also the yield in the market, so we expect that kind of reaction. Now, the focus on Powell's statement and the message, the signal is sent when he made mention of the fact that Fed was going to focus on the flexible inflation targeting as opposed to the ELB. Give the signal that because the flexible or the traditional inflation targeting kind of allow the Fed to also pursue growth and increase in other growth um, allows the Fed to pursue growth and also manage inflation. The mere mention of the fact that their decision was going to be data driven also gives some hope to the market that is not new jerk reaction. So the market reacted and responded accordingly. And we see that the equity market, as recorded by Dow Jones Index, experienced 1.9% increase on the 22nd of August as the market closed with 45,631 as the arrow is showing a sharp rise on the 22nd. Similarly, the Nasdaq also experienced the same increase with 21,496 closing at the end of the day. The arrow also show, or the movement shows, a rise from the previous record. Same for S&P. And when you look at the other world index like the Financial Times Stock Exchange on the London stock, you see as the arrow is pointing some rise, as we see a 0.1% rise on that day, which is around 9, the market closing around 9,321. Same for the European market as recorded by the MSCI, closing around zero point 0.4. This rise really shows, this arrow really shows the market experienced a rise on the 22nd. Same can be said of the Nike. So it's so clear that the market, the equity market really responded to the statement by Powell on the 22nd. And the bond market is no exception, as the 30-year treasury yield bond, US bond, really had a decline, and it's expected because the news caused a rush, and that rush caused price to increase. And as the price of bond increase, we know there's an inverse relationship between price and yield, and so that yield curve is what we are seeing here. Same for the 13 weeks, 5 years, and so on and so forth. So the major capital market, equity, i.e. equity and bond market, really responded on the 22nd August speech made by Powell, Jerome Powell. So it's so clear that a clear monetary signal was sent on the 22nd August, and that monetary policy expectation shaped investor expectation, which caused global market to move. And we see the movement in the equity market and the bond market accordingly. We and that would be the conclusion, that it's so clear that that speech really caused the markets to move. And the policy implication or lesson from this study is that it is not only firm specific news that cause the global capital markets to move, but also the macro policy event. And so Fed has to be very, very careful the kind of news it sends across, since that news is going to shape or cause the global capital markets to move. And I think it's right to say, as it is said metaphorically, that when US sneeze, all other economies catch cold. And it's true that the sneeze on 22nd August really caused the global capital markets to move. Thank you. These are my reference. Thank you for your attention.